Hi, my name is George Dagnino. As you know, I'm the publisher of the Peter Duck Portfolio Strategy and Management. Uh, this is a different video from what you're accustomed to because it's really the outcome of many, many decades of work. I started, well, let me go back even before this. I graduated with a PhD from Case. I came from Italy. I thought to go to a year to school and then go back to Italy. Instead, they said, why don't you go for your PhD? So I'm not sure I knew what I was going to do. I liked the country, so I stayed here. And so I went for the PhD. It was a tremendous program because I ended in a program that really was studying large scale system in a very abstract way, really, really major subjects. And so with that kind of mentality, at some point in my life, I said, well, I'm going to try to understand how the world works, believe it or not. So what I did, I found out that the National Bureau of Economic Research, we are talking now 60s, uh, did a lot of work and a lot of books on business cycles and how, quote unquote, the world works. Again, my slant was sort of quantitative because of my education. And so in those days, by the way, there were no computers, so everything I printed all these books by microfiche or whatever I found in the libraries, which eventually they threw it away because they were too old and no one was reading them. But what was fascinating about those books is because they were uh, the researchers from Mitchell, Burns, Moore, they were looking at the data and trying to figure out what the relationship between these, um, by the way, this problem came about after the Depression. They said, well, we have to find out how to measure the economy and what's going on. So, they started measuring number of checks signed, released by the banks in New York. For them, that was money supply. They started really very, very detailed measurements, and then, of course, they broadened it up. And then eventually, out of all this stuff, by the way, my book came about 40 years later. I put everything together. Uh, but at some point, I found this little booklet. And as you can see, there is a bookmark and there are charts. What is amazing about this booklet is that it has data going back to 1831 and until early 1900, and shows the business cycles uh, over that period. They show equity prices, they show commodities, copper, gold, interest rates, short-term rates, bond prices, business production. So they show the business cycle, and it's all done. It's really amazing because, again, being no computers, as you can see, it's all done by hand. It is an amazing booklet. I read it and reread it every time. But why is that important? It sort of dawned on me. I said, George, wait a minute. This guy is talking about business cycle beginning in 1830. He's talking about relationship between financial indicators since 1830. In those days, there were no major institutions in the United States. There were simply markets. That's how the markets were functioning. So I ended up, and here it goes back with this chart here. And and the amazing thing about this chart is because exactly the same, the same as I use in my presentations. So, but what is the point? The point is that what I show now, the data that I'm showing now, that I'm analyzing now, are the same. They have the same relationship as they had since 1831, more than 100 years ago, almost 200 years ago. And there was no Fed, there was no euro dollar market, there was all no that stuff. So why am I getting excited? Because the markets work the way they do. You can put over them or around them or inside them all the regulations and things that you want. but the markets will continue to have the same relationships between economic measurement. There's still the same relationship between, let's say, orders and production. First have to come out orders, then has to come up production. So this is a business decision. It's not a government decision. It's not a federal decision. So let me show you the chart now that is exactly the same as the one I showed you. And again, there was no Fed, there was no Treasury, there was no whatever. There were just plain markets and business running the show. This is the chart that I showed you before in this booklet that was valid since 1831. And I just take one relationship, okay, because I know you're interested in this one. But there are the same thing between inflation, for instance, and purchases of durable goods from consumers. The same relationship between rising interest rates and industrial production. So the lead lags exist, not because there is science fiction out there. It's just because business is making decision, is reacting to market condition, is reacting to the distortions created by the government and the Fed, and try to make some money. And all this is reflected in profits and stock prices. So I'm just taking one simple relationship and see that this is something that's always worked from 1831. This is to me is the amazing thing. So anyway, this is the the stock market. I know you're interested in this one. And this is interest rates. Okay. So what is the relationship that, again, since 1831 and is still valid now? And is this one is the stock market goes up after roughly sometimes a year and a half, sometimes 2 years. The longer it takes, the longer is the business cycle. But at some point, interest rates rise because business borrows money. They have to increase production. They have to hire people and pay them, so they borrow more. And they interest rates, of course, the banks raise interest rates because there is too much demand. So interest rates rise. At some point, though, the stock market peaks. Why? Because earnings slow down, because the costs rise. So interest rates rise, then this should be a hint to become probably more defensive. The stock market peaks because earnings peak. So then the economy weakens because things are not doing well because interest rates are rising. So at some point, the economy slows down and interest rates peak. But what history shows that after interest rates peak, they will have to come down substantially before the stock market rises. In fact, there is on average 21 months that from peak of interest rates and trough. Then once interest rates decline substantially, the stock market increases. Why? Because when interest rates decline a lot, business can borrow again, can expand, can hire people, can increase production. So profit increase. And then after a while, this cycle starts all over again. And this is so important. Again, in all this, if you notice, I didn't mention the Fed. People said the Fed pivots, the Fed peaks. It doesn't. The markets go their way. This shows that you could see in the last few days and a few weeks, interest rates kept on rising because the economy is strong, a business needs to borrow, and banks don't want to lend because they see problems ahead. So increase the spreads between treasuries and corporate bonds. The Fed doesn't have anything to do with it. The markets have tightened for the Fed. The Fed only function is to make the banking system, make it work correctly, as they did in March with the banks in California. But this relation always holds. And this is very important to establish, obviously, an investment strategy, because during this time, you want to be aggressive, but during this time, you want to be defensive. Again, if you want to know more detail, you can go to my website, www.peterdag.com, and I'll show you exactly where we are and what are the implications and what is my thoughts for the time being. This is a reminder that you can subscribe to my service and free, www.peterdack.com. This is a great book from the reviews that I got. I'm very pleased with that. I wrote 2 more books. And of course, you can follow me on the YouTube channel. Thank you very much for reviewing this video. Please do subscribe to my channel. And again, if you want more information about my service and what I write and what I think about current events, you can always go www.peterdack.com and you can access my services for free for a short period of time. Thank you very much. Have a wonderful day. So long.